Great. Last week we were talking about, the crisis of Italy in 1992. And it is the case that we were looking at one data set where we had information like about the nominal exchange rate of the Italian lira against the German mark. We had information about the CPI index of Germany, the CPI index of Italy. Like in a first step, it always makes sense like to plot the data and check how the time series look like. So we learned that in the beginning, the exchange rate, like the nominal exchange rate was fixed. And because we are still in the Bretton Woods era, and also in the end, like the exchange rate is fixed because the euro is introduced and Italy and Germany joined like the euro area. But in between, we can see an upward trend of the nominal exchange rate. This implies that the Italian lira was weak while the German mark was strong. So we observe here like a depreciation of the Italian lira and an appreciation of the German mark. But there is like one time period here which seems to be special. So from 1988, like to the beginning or like to the year 1992, August 1992, it is also the case that the nominal exchange rate is more or less fixed. So there was a time period when the exchange rate was fixed, but then it is also the case that here we can see clearly the outbreak of the crisis in the summer of 92, where like a strong depreciation of the Italian lira took place in a very short time period. So like this graph is related to the nominal exchange rate. And then, like I said, like it's also a possibility to look at the real exchange rate. So we had to generate the real exchange rate in one column. It is like the nominal exchange rate times the CPI index in Germany divided by the CPI index in Italy. And then we were able to generate like a real exchange rate. And when we plotted like the real exchange rate, then we learned that like before 1988, the real exchange rate was pretty constant. But then when the nominal exchange rate is fixed, it is the case that the real exchange rate is going down. So a real appreciation of the Italian lira takes place. How is that possible? Like, how is it possible that the real exchange rate decreases while like the nominal exchange rate is fixed? Yeah, like we have to look at the CPI indices and the inflation differential between like Germany and Italy. And we learned that Italy had like a higher inflation rate than Germany. So we calculated the inflation rate from 1988 to 1992. For Germany, it was like 15%. So 15 divided by 4, that's about 3.75 percent inflation in Germany. And then Italy, that's 27% increase in the price index. So like about 6.75% inflation per year in Italy. And of course, like when the Italian price index increases faster than the German one, then the real exchange rate goes down. So, like the German price index is in the numerator, and the Italian price index is in the denominator of this fraction. So, like we observe then in 1992, like the crisis, like the orange line, this is the real exchange rate. And then it is the case that because of this like depreciation of the nominal depreciation of the Italian lira, also like um, a real depreciation of the Turkish lira, like is caused here. So this is what we talked about last week. And then we said, yeah, like the next step has to be like we have to look at the Italian trade balance and like the next crisis, which is on our agenda, is France, like in 1993, France. So we have to get like access to the same data set. I think I made the data set already available to you. Like you can download them in Moodle. But also something else happened. Like it was a case that my course was evaluated, and yeah, I read through the evaluation. So like 6 out of 51 students, yeah, wrote an evaluation. And one student said, "Hey, like I don't want to learn about the old stuff. Like I want to learn about the crisis in 2012." So the recent crisis of the euro area. And I thought, hey, like why? So like I mean, if you understand 1992, then you understand 2012, right? So this was my way of thinking that it is not a waste of time that we are looking at old data set and old crisis because we can, as I think, learn something for the new crisis. But let's check. So, like, what happened afterwards? I created here like a new diagram where I plotted like the whole like real exchange rate over the time period from 1988 like to 2020. So like I just prolonged like this kind of data set. And like we learned here that from 1988 until like 1992, like a real appreciation of the Italian lira took place because the Italian inflation rate was larger like than the German inflation rate. And there was no velvet. So, like we also talked last week about a velvet, and there is no velvet because the exchange rate is fixed. And then, like because there is a inflation differential, it is a case that like the economy is heating up or the problem is heating up over time, and suddenly, like the exchange rate explodes. What we see like in the second half of 1992 and then 1993. Great. So, like one lesson which could have been learned like from this crisis is like don't fix the exchange rate, right? So we need a velvet. We need the floating exchange rate, and this could be like one lesson which was learned. But huh. Look at that. So, like here at this point in time, somewhere here, like the euro was introduced. So, once more, the two countries which are like involved, like are fixing their exchange rate by introduction of the euro. So, have they really learned the lesson from 1992? I don't know. So what's going on afterwards? Like the real exchange rate once more is decreasing, 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 decreasing. So like why? How is it possible that the real exchange rate decreases when the nominal exchange rate is fixed? Ben, raise your voice. How is that possible? What? Your microphone is still closed. Whom else do we have here in our lecture? Ah, Hoa, nice. So we ask Hoa, right?
Can you can you repeat the question again? I heard nominal
Hoa,
exchange
yes, of
rate and
course I can.
yeah, it's very loud here.
Yeah, but where are you?
With coffee.
Ja, schön. Ist auch nett. Nice, nice
Yeah.
learning environment. Yes. You can't understand anything, but you have a nice environment.
No,
So,
no, I just
like,
wanted to repeat it again.
yes, I will
Can you
repeat it
just
when you
repeat the
close your
question?
microphone. Thank you, Hoa. Like I asked the question, how is it possible that the real exchange rate decreases when the nominal exchange rate is fixed? Like the euro is introduced, nominal exchange rate is fixed, but the real exchange rate is decreasing. How is it possible? Hoa?
Maybe there are like changes in the prices like between the countries.
Changes in the prices are a
Like
little bit
the
what?
relative price levels.
Yeah.
Like we had like this formula, so
Okay, and where is the inflation rate higher? In Italy or in Germany? Ben,
in
where
Italy.
in Italy, right? This has to be the case. Like the real exchange rate is going down despite the fact that the nominal exchange rate is fixed. So it has to be the case that the Italian inflation rate is higher. And then it like the real exchange rate goes down, 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 down until like let's have a look. That's June 2012. So, like, what happened in June 2012? Oh, there is another crisis. There is like the euro crisis. Huh. So, like, I mean, the question really is like, have we learned the lessons from 1992? Yes or no? It doesn't seem to be the case because we made the mistake like a second time. And therefore, like my thinking was, like we don't have to talk about the crisis 2012 because you know everything about 2012 when you know what was going on in 92. That was like my way of thinking, but maybe, hmm, um, you see it differently. But then we can talk about it and also like talk about like what happened afterwards. So I will switch my slides a little bit because then I was thinking about, huh, 1 second. Do you have questions in the meantime? No questions. So I can proceed. And you want to see something? What I can see already. So let's beam my screen. So I said, like, it would be interesting to also look at the trade balance. Like we know that the real exchange rate might affect like the trade balance. So the next step is we need information about the trade balance. So I once more asked like the FRED database of the Federal Reserve Bank whether they have some information about the trade balance in commodities for like Italy. And they were providing me this very nice picture. So in 1988 or so, like the trade balance was balanced. But then we can see to some extent a deterioration of the trade balance. So like this is a time period where like the real appreciation of the Italian lira or the real appreciation of the Italian lira takes place. And yeah, this leads to a negative expenditure switching effect. So exports are down, imports are up, and then like the trade balance is deteriorating. Then like a crisis occurs in 1992, and a nominal depreciation of the Italian lira takes place, which is also causing like a real depreciation of the Italian currency. And hence you can see here that the trade balance is improving afterwards. So exports are up, imports are down, trade balance is improving after the depreciation has taken place. But then, somewhere in this time period here, Italy is once more fixing the exchange rate, and we observe like another phase of real appreciation of the Italian lira. And hence, you can imagine what happens to the trade balance. Like the trade balance deteriorates once more. Then we have a crisis in this time period here, and the trade balance improves. Like this is here, Corona doesn't matter too much. But can you see the similarities? Like fixing the exchange rate doesn't seem to be like a good idea for the Italians because of the fact that the inflation differential is still positive. Like the Italian inflation rate is higher than the German one. And then, like a fixed exchange rate system doesn't make too much sense for the Italians. This is the idea like I had with respect to the Italian case. And yeah, now maybe you want to have some time, like let's say 10, 15 minutes, something like that, that you can work with the French data and that you can like replicate this analysis which we performed for France, then also like for Italy. The that you can perform the analysis which we performed for Italy, now also for France. And I think I mentioned it at some point in time that France looks different. So France is in a completely like different situation than Italy. I think I mentioned it in the beginning. When we looked at the two countries, we looked at the exchange rates. And I said, like the Italian lira is depreciating in the 1990s against the German mark. But when you look at the French franc, then it is the case that despite the fact that there is a currency crisis in 1993, where like a depreciation of the French franc took place, it is still the case when you look at the whole time period of the 1990s, then it is the case that the French franc was stronger than the German mark. So when you now are analyzing the French case, then it should be the case that the French case looks a little bit different than Italy. So, like, I will give you the time to make this analysis. I will create small breakout sessions. So, four breakout sessions that you can go into smaller rooms. And I put the timer, let's say, to 12 minutes. Um, then you'll get into smaller breakout rooms now. Please accept the invitation so that you can work in smaller groups, and then we can like wrap up what you learned with respect to France. So let's go. So, like the video is running, let's have a look at the Excel file with the French data. Um, I once more relied on the FRED database. And in the FRED database, you of course are not able to find like exchange rates for like the French franc related to the German mark. But there was an exchange rate series like of the French franc against the US dollar and the German mark against the US dollar. So like I downloaded this information here, column number E, the exchange rate of the French franc against the US dollar and the exchange rate of the German mark against the US dollar in column F. And I thought like with this information, we can also calculate the exchange rate like French franc per German mark. So here I divided E2 divided by F2. And thereby we got rid of the US dollar, and I was able to get an exchange rate series for like the French franc German mark exchange rate. Then I copied like all the information down. And in a first step, of course, I also wanted to plot this kind of stuff. So we can see here like the exchange rate development of the French franc against the German mark. Um, of course, here, like in the end, the exchange rate once more is fixed because the introduction of the euro. Like overall, it is also the case that the German mark was stronger than the French franc when we look at the whole time period from 71, like until the end. So, like the French franc was depreciating, depreciating, depreciating. And the German mark was like appreciating. But this changed. So in the 1980s, you can see that here the French franc was relatively stable. And when you augment the picture and you are looking at the exchange rate in the 1990s, so from January 1990 until December 99, then it is the case that like the German mark is weaker than the French franc. The French franc is stronger. So it started at 340. It ended up at 335. So despite the fact that here was a currency crisis in the mid of the data set, it is a case that overall in the 1990s, the French franc was stronger. So like it's not like the typical Italian crisis. Since I had to construct my French franc German mark data set, like I wanted to compare the constructed data set like with the Pacific exchange rate data which we used in class. So this is the data set we used in class and it looks the same. So start at 340 and at 335 and then the two peaks in the mid of the data set. So, like, I think we can work with this data set where we generated the French franc German mark exchange rate series. And then, like, of course, in the next step, we need a real exchange rate. So here, the formula for the real exchange rate is the nominal exchange rate given now in cell number G2, then multiplied by the B2, like the CPI index of Deutschland, of Germany, divided by the CPI index of France, which is given in cell numbers C2. So the formula for the real exchange rate is the nominal exchange rate in G2 times the German price index B2 divided by French price index C2. And then I copied like all the information down to have a real exchange rate series. And then, like, I also plotted this kind of stuff over time. And there we can see that, like, from, I don't know, 88 to 93, it is the case that the real exchange rate is not decreasing, but in this time period, the exchange rate is increasing. The real exchange rate is increasing. So this indicates like a real depreciation of the French franc, which is not caused by a nominal depreciation of the French franc. So once more, it seems to be the case that the CPI indices play a role, but in the other way around, like for Italy, this curve was going down, but for France, it is going up. So here also I plotted once more the real exchange rate only in the time period from 1988 to when the crisis occurred. And there it is the case that the real exchange rate is going up, but not down. So afterwards, like I wanted to compute like um, the inflation rate of the German mark, and I used like the time period from like here July 88 till July 93. So, like the inflation rate in Germany was equal to 21%, and the inflation rate in France is like 15%. And therefore, like the story is completely different here. Um, the picture looks completely different. So the French franc is not the weak currency when it comes to the inflation rate. So it is the case that the French or the inflation rate in France is much lower than the inflation rate in Germany. And hence the trigger for the crisis has to be different. So it's not the case that we have like a lid on our cooking pot and there is no velvet or so, and the system is heating up, heating up, heating up, so that in the end, like the system is blowing up. No, it's different. So on this cooking pot, like there is no heat at all. So the story has to be different. And I mentioned once that some French politicians really became very self-confident, and they were once more talking about the Grand Nation, or and that they are now much, much more stable than the Germans. And they were talking about that maybe the French franc will become the currency in Europe, the currency in the EU. So they were so much like the politicians were so self-confident that the French economy will be stronger than the German ones. But then, like the markets said, "Hey, stop! We don't trust these kind of stories, and we will show you like who is a master of disaster in Europe, and that's not France." And then, like the attack occurred, the German Bundesbank didn't want to support the French franc. So the French central bank was intervening, intervening, intervening until they were running out of reserves. So the French central bank was, according to the Bild-Zeitung's article, like selling 100 billion in foreign currencies, and the Deutsche Bundesbank like was lending 2.5 billion to the French central bank. And that's really a signal from the Deutsche Bundesbank, hey, France, that's your problem, not ours. And then the system blew up. So here the situation is completely different. Um, so the Italian crisis and French crisis, they have different triggers. Any clear signal once more? Then I have to check where my slides are. They are here. Now you can see the slides. And like this stems from, or this slide deck stems from a very old, like, uh, yeah, lecture I gave in Denmark to some, like the target audience was like some managers which have their own companies. So the owners of some companies or like CEOs of some companies, like here in Denmark, it's about the economic crisis in Europe and the consequences of Greece's instability, and maybe the government of Greece will be insolvent, and maybe Greece will abolish the euro. So it was really in the beginning of the crisis. So the Greece is in the focus of this presentation. So, like in a first step, I wanted like to put a picture in my presentation. I thought about this one, but this looks a little bit too nice, so I opted for this one to start my presentation with. And what we saw, like in the first phase of the crisis, it was a case that the interest rate differential between Germany, the black line, and Greece, like the blue line, was increasing. So when we look at this chart, then in the beginning, in April 99, there was still like a positive interest rate differential. So the interest rate in Greece was higher than the interest rate in Germany. Um, and maybe that's puzzling for some students because they think, hey, isn't it the case that they are in the euro? No, like Greece in 99 is not in the euro. They joined the euro area like in the beginning of 2001. And then you can see here that the interest rate differential is more or less vanishing. So there is no interest rate differential at all. But then, like in 2008, suddenly the crisis is starting, and like the interest rate differential is increasing, and Greece has to pay like a positive premium. So Greece has to pay a risk premium when they want to borrow money. Here on the slide, I say it has no impact if, like this interest rate differential would have no impact in case that the Greek's government budget is balanced. So when the Greek's government budget is balanced, the Greek government would not have to borrow money, but the Greek government budget is not balanced, and therefore it is a problem. And suddenly, Greece has to pay a much, much higher interest rate compared to Germany. Furthermore, there is no impact if that like the debt structure of Greece, um, or if the existing debt of Greece has a very long-term structure, then Greece would not have to um, renew this kind of debt in the short run. And maybe we could wait until the interest rate differential is closing once more. So, definitely due to the fact that Greece has a huge due to the fact that Greece has a huge government budget deficit, it is a problem. But because now financing the government budget deficit will be more costly for Greece. Then a first Greek rescue package was initialized, and it was a case that 45 billion euros were raised, and each country had to chip in. Like according to the size of the country, each country had to chip in this rescue package. And then I said, hey, this package doesn't seem to be large enough because of the fact that the debt is much, much higher than 45 billion euros. So the first Greek rescue package is very, very small compared to the existing debt. So Greece has a GDP of 220 billion euros, and like the ratio, like debt to GDP, is larger than 100%. So, like the outstanding debt is, I have no idea, like 300 billion euros, but the first rescue package only has a size of 45 billion. So I directly said, like this package is much too small because, like, with the beliefs in the solvency of a government, it is similar to the beliefs in Santa Claus. Like if the trust is gone, it will never come back. And hence, um, we saw more and more rescue packages. So here in one cartoon, you can see Angela Merkel, and like she's saying, "I want to have more packets." So like the countries once more like had to step in, and all the different countries in the EU like had to chip in something. Um, in the EU, like here we only have countries of the euro area, but in the end it was also the case that EU countries had to step in. So the first package was too small. We need more packages. Then I was thinking about like what would you do in case that we talk about one like private household, like one family, like which has a problem that the budget of the family is not balanced. So how can we solve the problem like for like a private family? And like at that point in time, it was the case that Peter Zwegert was very famous. Like he's the anchor man of one series in the German TV. And like he was always helping family which had built up much too much debt, 100,000 in consumer credits or something like that. And like he um, always followed like this kind of approach here in order to help the families. So the first step was always to get an overview about the debt situation of the family. And that was sometimes very burdensome because the family was not openly communicating the debt. And then he found like one contract for a mobile phone here and one consumer credit there. And then the wife had something here and the husband had something there. And the wife and husband didn't communicate with each other. So they were also surprised about the debt situation of the overall family. So this is the first step to get an overview about the debt situation. And this was also not easy in Greece. It took a while until somebody found out how large like the government budget deficit was. Then you have to analyze revenues and expenditures. For a family, how can you boost like revenues? Yeah, you have to find a job. You have to work harder. You have to find another job. You have to cancel very expensive mobile phone contracts. You have to sell your car, and then you have to move into a smaller and less expensive apartment. So this would be like the adjustment, like from the microeconomic perspective, if there is one family which has a problem. But in Greece, like find a job, work harder, find another job, it's very problematic when the whole economy is in a recession and we saw youth unemployment rates of like above 40%, overall unemployment rates of 25%. Like finding a job is then impossible. Yeah, sell your car. Yeah, of course you can sell your car, but when the whole economy, like all the people in Greece, have the same problem, to whom do you want to sell your car? Like, do you want to sell your car to the Germans or like this works in a microeconomic perspective, but it doesn't work in a macroeconomic perspective. Especially like the last item, like move into a smaller, less expensive flat. Yeah, like when all the Greek people have the same problem, then where do you want to move? So this also doesn't work on a macroeconomic perspective. Then, like third item was always you have to call the bank. You have to renegotiate and reduce the installments, so like pay later. Then you had to mobilize liquidity reserves like friends and family and get a waiver, and you have to refinance with a longer maturity and smaller installments. The wafer is very important. So, like sometimes it is a case that one family had debt of 100,000, and like some friends and families, like I don't know, the grandparents, they were able to give like 25,000 euros. And then Peter Zwegert went to the bank and said, like, here, you can get 25,000 cash in a cash, like cash today. But then, like, you have to abolish like the claims of 100,000, or we do not pay like 25,000 and you will receive nothing. So, with this like little trick, Peter Zwegert was always able like to get away for, so he was always able to reduce the debt tremendously, like when he was able to mobilize some liquidity reserves. But here, when it comes to Greece, it's a question like, who are the friends of Greece? Like, whom can we talk to? And when we see like this rescue package here, uh, this is too small. So it doesn't seem to be the case that the Germans are the friends. So who are the friends of Greece? I have no idea. Whom should we call to get away for? Uh, this is what I thought about. Could be an interesting perspective, like to compare the microeconomic perspective and like the macroeconomic perspective. What's next? Yeah, I once more looked at um, one price index. So previously, when we talked about Italy and France, like we looked at the CPI index. But here I was looking at the GDP deflator, and you can also like use a GDP deflator to compute like an inflation rate. And here, like the GDP deflator is normalized to 100, I think in the year 2000, something like that, or 2001, I don't know. And yeah, like what about the inflation differential? Whom do we have on the list? Like Germany, that's a black line. Then we have Spain, Greece, and Portugal. So, like, black line, that's Germany, Spain, Greece, Portugal. They have a higher inflation rate than Germany. So we are back in Italy, 1992. So the same stuff, the same story happened here. So, I tried to use like this graph and make a numerical example. So let's calculate a real exchange rate here. Um, Formula is given here. So like in 2001, it was the case that everything was normalized to 100. But then it is a case that the price index in Greece is at 130, and the price index in Germany like is only at 110. So in 2001, when you want to buy one good, it costs 100 in Germany, and it also costs 100 in Greece. So we have a kind of a level playing field here if you want to. But then, like 10 years later, it is the case that the price is available in Germany for 110, and the price of the good in Greece is for 130. Huh. Yeah, because the inflation rate was a little bit higher in Greece. So, like Germany has a trade balance surplus, Greece has a trade balance deficit. So, how can we put like this equation once more into balance? Option one is we have to inflate the German economy. So, it has to be the case that the inflation rate in Germany increases. And this was also discussed. Hey, Germans, you need to increase your wages. So when your wages are higher, the inflation rate in Germany will be higher, and then we are on a level playing field again. This, of course, would work in case that the whole world consists out of Germany and Greece, But there are also some other countries Germany is trading with, and they would not be amused in case that the Germans like higher the wages so that the prices within Germany increase, then like the other countries would not go shopping in Germany anymore. The idea number two, like option number two is like we have to deflate the Greek economy. So like the prices have to decrease in Greece. But what does it mean? Like also the wages have to decrease in Greece, like the nominal wages have to decrease in Greece. And what we observe then is like we have strong labor unions in Greece. So like the workers are not working anymore. They are on the streets. They are protesting. They are on strike. They are against wage cuts. And when you are on a strike, you are not working. So when you are on a strike, you are not producing GDP. You are like causing also, or you are contributing to the recession when you are not working. So like option number two is very burdensome for the Greek society because they have to accept um, a wage cut of the nominal wages. Then another idea could be to devalue the Greek drachma. This could also be an idea. So option number three is we are introducing like a German mark once more. We are introducing a Greek drachma, and then the exchange rate, like once more, we are creating like a velvet into the system. So in case that there are like higher inflation rates in Greece, then the velvet can function. But and this is also like what I said in the beginning of the talk. Like um, here, like we talk about, is it an option that Greek is like leaving the euro area, like Ultram, like austreten, like is leaving the eurozone. So like option number three, like is already discussed or mentioned in the title like of my talk. And we didn't went this way. So this was not the way we went. Um, this was not the solution. Then option number four is yeah, the ECB buys bonds. Yeah, we are staying in this scenario, and the ECB will buy bonds forever. Another idea could be like Germany is increasing taxes and is shifting like these taxes directly to Greece. This could also be a nice idea. We are taxing the German workers and then we are sending the goods directly to Greece. Then we can finance like the Greek trade uh, balance deficit forever. Yeah. So this would also be like an idea to have. Yeah, maybe it is a little bit unpopular to increase taxes in Germany and shift the goods to Greece, but we could label it like a European unemployment insurance. So how does an European unemployment insurance work in case that we have 8% unemployment like in Germany and we have a 25% unemployment rate in Greece? Yeah, like we are getting some like revenues from the unemployment insurance in Germany, and then we are shifting it to Greece, and we are financing the unemployment benefits for Greek workers by a European unemployment insurance. So, like option number five was also discussed, was on the table, and this kind of option was disguised as like a European unemployment insurance. Um, yeah, then I was thinking about what do we know about Greece? Um, First idea was Greek government is consuming too much. And then I looked at government consumption in percent of GDP, like Greece. This is the blue line here. So that's Greece. And then, scheiße, wer hat da was drauf gemalt auf diesen Mist? Ich brauche einen Radierer. Okay. Like the blue line, that's Greece. And then the line here with the first line, that's Germany. Yeah, Greece government consumption is smaller than Germany. Huh. I thought, how is that possible? Then I reframed like my initial thought, like Greek government is consuming too much, and I replaced it into Greek government is spending too much compared to its revenues. So I was looking at revenues of Greece. This is like Greece revenues. That's the blue line, and the light blue line. This is Greece expenditures. And then Denmark revenues, that's the red line, and the pink line, this is Denmark expenditures. Because I gave the talk in Denmark, I had to make a reference to Denmark here. And in Denmark, it was the case that in the beginning, the government was running like a government budget surplus and then a government budget deficit when the crisis kicked in. But in Greece, it was like always a government budget deficit, and the government budget deficit even increased like during the crisis. So like here, this is like 50 in expenditures, 38 in revenues. So the government budget has a government budget deficit like of 12%. So it's not so much that Greece is spending too much for the schools. Greece is spending too much for the police or the military or so. Like, what is Greece spending on? Like, here we have one graph where we look at pensions for workers entering the labor market today are too generous for Greece. So that's the gross pension replacement rate is 95%, while like in Germany it's only 43%. So like it is the case that the pension system in Greece is much too generous, like, and this is causing like the huge government budget like deficit. So I think here I would like to stop my presentation because like we can detect a pattern, and I think the pattern like is revealed in this graph. So like all these countries are member of the euro area. The exchange rate between these countries are fixed, like the nominal exchange rates are fixed, but it doesn't imply that like the real exchange rate also is fixed. The real exchange rate is not fixed, and we see here like the Italian case, like these countries have a much higher inflation rate than Germany, and this implies, yeah, that the prices increase faster in these countries. And suddenly, like we have a cost difference like of 20 euros, like of about 20% here. And this leads like to a trade balance surplus in Germany, a trade balance deficit in Greece. So it seems to be the case that like some countries are like fixing their exchange rates, and these countries are too heterogeneous in order that this can function. Um, and it doesn't work. So this is what the crisis once more told us. It doesn't work. So like let's think about it. Let's make like uh, one last argument like to this slide. Let's assume uh, uh, wait a second. I try to find another slide. I have to check here, macroeconomics. Um, Still there. I'm just searching for something. I found it already. So back to Zoom and then freigeben, this one. Like in our like macroeconomics 101 class, like the very beginning of macroeconomics, we had a look at this graph and we saw that like the inflation rate was like pretty high in the 1970s because like there was an oil price shock here, then there was an oil price shock here. So the inflation rates were pretty high. Then the inflation rates decreased. And then like the ECB took over the responsibility for the monetary policy in 99. So that's start of stage three. So here the ECB took over and the ECB promised an inflation rate of 2%. Was the ECB successful? Yes, seems to be the case. They promised 2% inflation and they also delivered like 2% inflation. They delivered 2% inflation in the euro area. And this 2% inflation is in line with the following story. Like we have 2% inflation in Germany and we have 2% inflation in Spain. So on average, like we have a 2% inflation rate. But it could be also the case that we have like no inflation in Germany, but we have 4% inflation in Spain. Then also on average, like we have a 2% inflation rate in the euro area. And we know already from the slide desk today that it was a case that there was a higher inflation rate in Spain compared to Germany. And this has consequences like for the real interest rate. Let's assume that the ECB has implemented like a nominal interest rate of 4%. How large is the real interest rate in case that the nominal interest rate is equal to 4% in Spain and the inflation rate is also 4% in Spain? So how large is the real interest rate then? The interest rate is defined as the nominal interest rate minus the inflation rate. So, like when you have a 4% nominal interest rate and a 4% inflation rate, the real interest rate is equal to zero. So, this implies that it doesn't cost anything when we are borrowing uh, something in Spain. So, the Spanish society has the perception that it doesn't cost anything when I'm borrowing money. So, like, of course, it costs 4% in nominal terms, but the prices are also increasing like by 4%. So it doesn't cost anything. And when the house prices like increase by more than 4%, then it is a case that the real interest rate is even negative in Spain. And then like um it makes sense. Like when the house prices increase by, I don't know, 10% per annum, the house prices increase by 10% per year, and the cost of financing is only 4, like it makes sense to buy uh, the a new to buy new houses and buy a new summer house and construct a new summer house because the cost is only 4%, but the revenues are increasing by 10% when you are invested in the Spanish real estate sector. And hence, like the ECB was able to deliver like 2% inflation, but the countries are like too heterogeneous. So we have the situation 0% inflation in Germany, 4% in Spain, and hence it doesn't cost anything to borrow money in Spain and invest it in the real estate sector. And then a real estate crisis emerged in Spain. Suddenly, like a lot of construction workers are unemployed in Spain. Hmm. Is it a surprise? Don't know. Don't know, don't know. Um, I will, and I have to switch on the video signal again. So a few remarks with respect to the structure of the exam. So we have talked about the first, second, third generation crisis model. And we will cover this kind of stuff in like the multiple choice part of the exam. So like the first part is multiple choice. And um, in case that you attended our lecture, like you know how the degree of difficulty looks like the same stuff as you had to do like in your weekly multiple choice quizzes. And then like we will have like two graphical problems where you have to discuss like a shock in one of the macroeconomic models you got to know in our like lecture. Um, like graphical solution of a shock. We had some readings during our course. Like one was related to the Swiss currency crisis. So the title was like "Who put holes in the Swiss cheese?" Something like that. So I would read this kind of stuff once more. Um, and then we will also have a part related to Virgil. Um, so also there we'll have a multiple choice part and then one, yeah, deeper question with respect to the movie. So this will be the structure of the exam. The exam will last 90 minutes, not 120, because you already worked on the group assignments. So the duration of the exam is 90 minutes. Any questions related to the exam? Thing. Great. Then I don't know, like from my side, I would say that's it. So I covered like all the material which I wanted to cover. In case that there are no questions on your side, I would like to thank you very much for like attending like the overall course. I hope that you found it to some extent interesting, despite the fact that we talked a lot about old stuff. But like when you understand the old stuff, like then you can directly apply it also for the most recent crisis. And like I don't know, the Swiss crisis, the crisis of the Swiss franc is directly related like to the crisis in the euro area, I would say. So the euro area is weak, the Swiss franc is strong. So there also like you are able to get some insights into the most recent crisis. So thank you also that you stepped by today and yeah participated in this online session. So thank you. And then I would say like no lecture tomorrow. Only when you have questions which we cannot clarify like right now and today.
Um, I actually thought of a question. So you mentioned the graphical problems. Are they gonna be related to something new? Because you said, yeah, we learned about the old crisis and then applying it to like a newer crisis. Or are those crises, like the graphical problems, are they gonna be related to the crisis that we have learned about, like the French crisis, the with Italy, with Swiss are like problems that we've
So,
already discussed in class, or
okay. Can you close your mic? Okay, thanks. Um, like I would say in the exam we have a strong focus like on the theoretical part. Like when I'm talking about a graph, it is a case that you have to draw like a macroeconomic situation, and then one shock occurs, like one curve is shifting in one direction, and then you have to find like the new equilibrium. So this is more related to the theoretical part, like the exam is more related to the theoretical part and not too much to the empirical part.
okay, so it's also just gonna be the ISLM or the ISSZ and the
Yeah,
LM
right.
and not the ASAT, right? Because I think
This is right. So we talked about the ISZZ LMZZ model of the open economy, in case that the economy is not capacity constrained, so a Keynesian model. This is one model class. Then we talked about a kind of monetary model where we labeled the two curves like IS and LM, and worked in this diagram where we had money supply, the goods prices, and the exchange rate on the three axes. So there we worked in an open economy which is capacity constrained, so GDP cannot change. And then the last theoretical model which we used is an ISLM model of the closed economy setting when we talked about Virgil. Yeah. So these are the three model classes which we introduced. And then, of course, also like a first generation, second generation, third generation crisis model, where we also had theoretical models introduced.
and then the last thing that I wanted to ask, like the comparison part, like in the group assignment two, the last task is about the crisis in Latin America, and the comparison, is it just to say, okay, this crisis in Argentina is this model and this is this, or do I need to talk more about the differences between the models, like between the
Um,
crises?
like, like I would say the exam is focusing on what we did in the lecture and not too much on what you did in the group assignments. So you can expect more like what did we talk about, like breakdown of Bretton Woods. We talked about the French crisis. We talked about the Swiss crisis. In the third generation crisis model, we talked about the Asian crisis.
No, I just meant like the now question is about the group assignment. Just like, is it
I would
enough the
say
comparison
no,
between the
no
crises?
question about the group assignments.
Ah, okay.
Other questions? Yeah, then thank you so much. Like all the best for the exam. And yeah, hope to see you around, maybe next semester. And all the best for you. John, vielen Dank. Danke, danke. Have a nice day. Thank you so much. Bye bye.
Danke, gute Besserung.
Jo, danke.
Tschüss.
Tschüss, Ben.